Hello everyone, hi. Welcome to the channel of Wall Street Mojo. Watch the video till the end, and if you're new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we have a topic which is unrealized gains. Well, unrealized gains are like, notional things that's happening here and there. So what exactly this is all about? Okay. There's an extract here of the fiscal year ended. Net earnings included the non-controlling interest, and in the other comprehensive income, there are details for unrealized holdings. What exactly this is all about? Let's try and understand. See, unrealized gains and losses is like, increase or you can say decrease in the value of the asset, that is not yet sold for cash. And it is also called, the paper profit. It's a paper profit, or, it can be called as the paper loss. So unrealized gains and losses can be thought as money on paper which the company expects to realize by selling the asset in the future. So when the company sells the asset, it realizes the gains and pays the taxes on such profits. There's a portfolio valuations, mutual funds, NAVs, and some tax policies that depend on the unrealized gains and losses, which are also called as mark to market. Let's calculate the unrealized gains and losses with the help of an example. Unrealized gains, example number one. Let's say there's a company called XYZ and it has an investment of, let's say, $10,000 in stocks, which it holds for the trading purposes. Now, the value of the three stocks, let's say, has increased to $25,000, and the company could record 15,000 as what we call as the unrealized gain on this position without actual selling of the securities. So this will only be paper profit, and the company will not be liable to pay any sort of what we call as taxes for such recordings and for such recorded unrealized gains. So however, he sells these positions, let's say for 30,000 later in the year or next year, and it would record a realized gain of, let's say, $20,000 in the net income, and is liable to pay taxes on such gains. So from the above example, we can say that unrealized gains is the difference between the value of the investment now and the investment done by the person in the past. Let's take another example, example number two. Let's take another example. A person, let's say ABC, has bought 500 stocks of, let's say, 3 each with the original investment value of 1500. So he paid a brokerage of, let's say, $10 on the purchase of these stocks, and the current value of the stock is standing at $7. So here the total value of the investment is going to be, it's 3 into 1500, that's 4500. Sorry, it's going to be 3500. So the unrealized gains is going to be 3500 less 1500, that's going to be 2000. Precise, the person can subtract the brokerage paid on the stocks and say the unrealized gains will be 2000 less 10, that's 1990. The above examples were from, to calculate the unrealized gains and losses. Now let's take a real unrealized loss or gain example. As a dot-com company, bubble created a lot of unrealized wealth. The dot-com bubble, if you realize the dot-com bubble, it had created a massive unrealized gains or the wealth, and that it evaporated like crash happened, during the dot-com boom. Lot of stock options, RSUs, the restricted stock units, were given to the employees as reward and incentives, and it's so many employees turning as millionaires in no time, but they could not realize their gains due to restrictions to hold them for a time period, and thus dot-com bubble crashed and all the unrealized wealth evaporated. Now let's understand the accounting portion of the unrealized gains and losses. So the accounting treatment for the unrealized gains and losses depends on whether the securities are classified into three types. First, whether it is held to maturity. Securities, well, unrealized gains, and losses on securities held to maturity are not recognized in the financial statement, and such securities do not impact the financial statement, like the balance sheet, the income statement, and the CFS, that is the cash flow statement, right? And many companies may value the securities at market value and may choose to disclose it in the footnotes of the financial statement. However, if the market value is not disclosed, held to the maturity securities, they are reported at the amortized costs. Second, trading securities. The securities that have been held as the trading securities, they are reported at what we call as the fair value in the financial statement, and the unrealized gains or unrealized losses, they are recognized on the statement and the impact of the net income of the company. So although the securities have not been sold to realize the profits, gains, they increase the income, and thus the increase in the EPS, that is the earning per share, and the retained earnings, there is no impact of such gains on such cash flow statement. Third, we have available for sale securities. Now, available for sale securities also reported at what we call as the fair value. However, the accounting for such securities, they differ a lot. They differ from the trading securities. So due to the fair treatment for the availability available for the sale securities, unrealized gains or unrealized losses are included in the balance sheet on the asset side. However, such gains do not impact the what we call as the net income of the company. So the unrealized gains on such securities are not recognized in the net income till they are sold and the profit is realized. So the unrealized gains, they are reported under the shareholders' equity as the accumulated other comprehensive securities. Now, the unrealized gains and losses on the income statement and balance sheet. Let's understand that. See, the accounting treatment for various types of securities and the impact on the financial statement. Thing like this, I'm going to take you to the tabular statement. There are type of security. It is valued at generally amortized cost. There is no impact on the balance sheet. On income statement and cash flow, again, there is no impact. For trading securities, they are valued at fair value. On the balance sheet end, it is recorded. The unrealized gains and losses are recognized on the balance sheet. And same with the income statement, they are recognized in the P&L and the impact on the net income. In CFS, there will be no impact. For the available for sale, it will be recorded at, again, the fair value, and the gains and losses will be recognized in balance sheet. Same, there won't be any difference. But over here, the unrealized losses are not recognized in the P&L, and there'll be no impact on the CFS, right? So this were the tabular thing that I had to make you understand. Now, there is importance of unrealized gains losses. Like it is good to know the unrealized gains on the portfolio, but it helps to track the performance of the portfolio. Although they are only what we call on paper profits, but they give a good estimate of what actual profit could be in the near future if the positions are sold. Second, the unrealized gains or losses will help in the what we call as the tax planning, and taxes are paid on the realized gains. So thus, by knowing the unrealized gains, the company can forecast the amount of the tax to be paid if they sell the securities. Third, the investors, they can plan when to sell the security and to realize its gains. Now, holding a security for a longer time may reduce the tax implication, and that will be treated as what we call as the long-term capital gains. So thus, the investor can plan and sell the security after 1 year of its purchase and then selling in the same year to reduce the tax implication. Finally, on the concluding end, you can say that the unrealized gain is an increase in the value of the investment due to the increase in the market value of the calculated, because that is the fair value minus the market value, and such a gain is recorded in the balance sheet before the asset has been actually been sold, and thus the gains are called as the unrealized one, because no cash transaction actually happened. And for securities, except for the trading securities, the unrealized gains do not impact the so-called the net income, and the gains are realized only after selling the asset for cash, because it is only when the transaction has materialized. That's it for this particular topic. If you have learned and liked the video, if you think that if you have enjoyed and learned watching this video, please like, comment on this video and subscribe to our channel for all the latest updates. Thank you everyone. Cheers.